Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Reactive technical analysis versus predictions. Trend followers are the group of technical traders who use reactive technical analysis. Instead of trying to predict a market direction, their strategy is to react to the market's movements whenever they occur. Trend followers respond to what has happened rather than anticipating what will happen. They strive to keep their strategies based on statistically validated trading rules. This enables them to focus on the market and not get emotionally involved. Covel. Traditional technical analysis is based on forecasting future price movements based on past price action. This book is about reacting to current price action. The best traders in the world stay flexible and can change their trades quickly. They can also stay with a winning trade and allow it to trend as far as it will go, capturing huge wins when possible. Reactive technical analysis doesn't exit a winning trade until there is a reason to exit, and it prompts traders to exit losing trades when price action proves them wrong. One of the worst things you can do is try to predict what will happen next. This is a waste of time and energy, and a great way for a trader to sabotage months or even years even of trading profitability. Traders and investors must have preset price levels that they will adhere to, so they can realize they are wrong and change their course, rather than losing more money or missing a trend. One of the worst things you can be is a stubborn bull in a bear market or a stubborn bear in a bull market. All traders must have the "I am wrong" signal. How many times do we see a talking head on financial television or a trader or investor on social media blinded by their own bias? They either have a theory that a market crash is imminent based on some macroeconomic trends or other outside influence. I don't care what people say or predict will happen. My question is, what position do they have right now to prove their beliefs? The most opinionated people you will find typically don't have any current market positions, and they are only expressing their opinions. Ignore them. I have found over the years that the profitable traders and investors carry their opinions lightly and their stops tightly. It is easy to hold a bearish opinion about the markets, and then while you hold that bias, the Dow Jones Industrial Average moves 2,000 points up in a few months. If you are in cash, then you have missed a large market move. If you are short, then you have lost a large amount of money. The point of having a signal is to have an external event that forces you to change your position in the right direction. What if in the summer 2009, a trader was bearish on the chart, and the initial failure to break out over the 200-day made him believe we were doomed to return to all-time lows? All he heard was bad news on television and online. He was negative, saw no hope for a rally, and was ready to sell the market short. This is what his chart might look like. Charts courtesy of stockcharts.com. What would he need to see to change his bearish bias? From the look of the chart, he had some good reasons to be systematically bearish, and even short. If he was short, then he should have a stop-loss level where he would be proven wrong. Maybe a close back over the 200-day moving average would have made him exit his short position. If he was in cash, he would need to know what level would get him short again. A failure at the 200-day moving average and a reversal might make him sell short into strength again. Here is what I would look for: a reversal out of this downtrend and a potential uptrend starting. A bullish crossover of the MACD, the black line crossing over the red line signaling upside momentum. The RSI crossing over the 50 RSI and getting back on the bullish side of the chart. Price closing over the 200-day simple moving average, showing that the bulls are willing to buy over that line, and that selling could be exhausted below it. These are momentum buy signals. We are looking for the market to confirm the beginning of momentum and the start of a new uptrend before we enter. Here is what happened next. Charts courtesy of stockcharts.com. I tried to keep this chart as simple and clean as possible so you can see how the signals we were already looking for played out, and how the chart evolved after the entry signals were triggered. Entry signals are just step 1. Managing the trade through position sizing, trailing stops, and targets are part of the bigger picture. We will cover these signals in depth in future chapters, but I wanted to give you your first glimpse of how everything can change in a market, and how you need to be flexible enough to go with the flow. The quote at the beginning of this chapter is from my friend and trend-following expert Michael Covel. He has spent many years studying what makes trend followers successful in the markets. Trend followers create systematic ways to capture trends in financial markets through technical trading rules for entries and exits that put the odds in their favor. This school of thought had the biggest impact on my development as a trader. While I have evolved my trading for different market environments and shorter time frames, trend-following principles of reacting instead of predicting has been at the core of my profitability. I have always been adverse to risk, so I had no problem cutting my losses short because I hate to lose money. And because of the bull markets in equities in 2003-2007, it was easy to let my winners run and become very profitable. Most people have little trouble in bull markets. It's when asset values start going down and stay down when the trouble begins. As technical trader, it is our job to create systematic ways to capture trends on our trading time frame, and we have to let price guide our entries and exits. We are attempting to go with the flow of capital into and out of the market, and develop signals that get us in at the right moment to capture a trend. Our exit signals will get us out when we are proven wrong for a small loss, or allow us to lock in profits when it appears the trend is at an end and ready to bend. We aren't trading our emotions, beliefs, or predictions. Price action will be our guide on our journey to profitability. Analyzing a chart to predict what will happen in the future is not the same as looking at current conditions and setting buy and sell signals targets if a price level is reached. Your signal has to be based on the current reality of price and not the future expectations of price. A systematic approach may not always work in the short term, but it is designed to keep the odds in your favor so that over the long term you will be able to capitalize on profitable trends. A price trading system exposes your capital to the opportunity to capture a trend while limiting your losses when wrong. Your position sizing and stop losses will be just as important in your trading system as your entry signals. Your ability to follow your signals will be just as important as the quality of the signals that you create.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye bye.